Now we come to the part of the show where I talk about what I think individual investors should be considering before they make their investment decisions. And as usual, we have our list of 3 topics. And these are for this show, economic indicators or economic data. And these are the data that I guess we all focus on, or we should be focusing on, the data that tells us what's going on with inflation and growth in general. And this always seems to be on our list. But once you get through earnings season, and we're about to enter into a new earnings season as the first quarter has now ended, between the 2 earnings seasons, well, we tend to focus back on the macro, the economic data for the country, and why that's so important for things such as interest rates. So we'll talk about economic indicators or economic data. 1 cut or 2. What I mean by that is cut in interest rates. Coming into this year, the market actually anticipated as many as 5 or 6 interest rate cuts. Now the market is anticipating maybe just 3 cuts. And from some of the conversations I've heard from Federal Reserve governors, maybe 1 or 2 is now the new number to consider. So we'll speak about that and why that's important to focus on. And my third point is patience. How many times have someone told you to have more patience? Well, this is patience in investing. Don't go off and chase the market higher. Don't go off and chase certain stocks higher. Have some patience. There are a lot of opportunities out there. If you don't find one right away, have some patience. Look to other areas or perhaps other ideas in the same sector, and have some patience and perhaps do some homework to find some good quality names. So let's move on with our first point, which is economic indicators or economic data. And we actually received today the producer price index report out of the U.S. and showed us that things are coming in a little bit hotter. Sorry, we actually received private payrolls. Producer price index we received a few weeks ago. Private payrolls we received today. These are job growth from private companies. And that number came in a little bit higher, a little bit hotter than anticipated this morning. Now, do I think that you can extrapolate from the private payrolls to the non-farm payrolls on Friday? Sometimes you can, but a lot of times those numbers actually don't go together well. And we're going to get a jobs data out of Canada and the U.S. on Friday, the non-farms payroll. And we're expecting out of the U.S. approximately, about 215,000 jobs created. And again, I always focus on the U.S. a little bit more than Canada because the market tends to move with U.S. economic data more so than Canadian data. So we're going to get a number on Friday, and it's going to tell us with the story about jobs. Obviously, the more jobs created, the more money people are making, and therefore, in most people's opinions and the opinion of the Federal Reserve, the more difficult inflation may be to start to see it come down further. When people are spending more and more because they are employed and have jobs, that tends to be impacted negatively on the inflation number. Inflation tends to stay stubbornly high or go even higher. So we're going to get a jobs report on Friday. Then next week, I believe on Wednesday, we're going to get an inflation number out of the U.S. Once again, a crucial number. We've seen inflation tick a little bit higher in the first quarter from what was expected. Many were hoping that we would see inflation with a 2 handle in front of it, or starting with a 2. We still see inflation just above 3% in the U.S. So we're going to get inflation numbers on Wednesday, and not necessarily economic data, but we're going to get a Bank of Canada announcement on interest rates next week as well. So a lot of important data points to focus on if you're an individual investor over the next few weeks. We have a couple of charts here that I'd like to show. The first one is on Canadian employment change, a nice bar chart here. For some of you that can see the top writing, it just goes into jobs here in Canada. We grew over 40,000 jobs in the month of February, and that was actually higher than the 37,000 jobs created for the month of January. So we're seeing a spike. You can see it here on the far right on the bar chart. The last 2 months have definitely moved significantly higher on the jobs front here in our country. Is that a sign of perhaps more growth to come down the road? Well, we have a GDP chart that will show you that, and I will show that shortly. But before I do, let's go into the U.S. Jobs growth on a monthly basis. And you can see here back in February, 275,000 jobs created, above what we saw in January, not quite matching what we saw in December, but again, very strong numbers. And when the Fed when the Fed sees these numbers, it gets a little concerned because wondering how the inflation rate will pull back when people are spending a lot more money. Here you have the next chart, U.S. Consumer Price Index, and we can see here that the inflation rate in the U.S. 3.2%. The core rate, when you take out volatile food and energy, looking at around 3.8%. Once again, those numbers kind of flatline. We saw them come down very rapidly, but they've been in and around just over 3% on the headline number and 3.8% on the core number for a little bit now, for a number of months. Quickly here, we have our next chart, which is the Canadian inflation numbers, core inflation in Canada. Actually, this is Canada's headline inflation, eases to an 8-month low. We're seeing at 2.8%. Core is around there as well. Core inflation rate, similar. But you can see here that the interest rate in Canada, Bank of Canada rate, is 5%. So a very big gap between where inflation sits today and where the Bank of Canada has the interest rates for the moment. And in talking or hearing Bank of Canada speak, you don't really anticipate them moving on interest rates anytime soon. So again, keeping, I guess, one eye on markets, but also another eye on the economic data that's coming out and how it's going to, in fact, affect the inflation rate, how it's going to affect interest rates, which obviously affect the stock market. Very important for individual investors to consider. Basically, the next point that I wanted individual investors to consider before you make your investment decisions is this idea of how many interest rate cuts we will see or receive in 2024. More so, again, on the Federal Reserve side. We've heard Federal Reserve governors recently talking a bit about how once upon a time they saw 3 cuts. Maybe now they're only seeing 1 or 2 interest rate cuts. Although if you listen to the Federal Reserve, the head of the Fed, which is Jerome Powell, in his last speech, he still maintained that he could see 3 interest rate cuts here or in the United States. Bank of Canada as well. Market is anticipating the Bank of Canada cutting rates 3 times. But once again, I think the market is starting to grapple with this idea that the longer it goes before we get that first rate cut, the less likely we're going to see a number of them this year. We may only see 1 or 2. And recently I heard from an economist, an analyst, saying that we may not get a rate cut at all in the US this year. And Canada, we may see only 1 or 2. We have I think one of my favorite charts of the show, of the week, is the chart we have here about changes in the Bank of Canada policy rate. And you can see here that the upcoming meeting next Wednesday, there's basically an 83% chance that the Bank of Canada is going to do nothing. Only a 17% chance that they could lower a 1/4 point. But when you go out to the next meeting, which is the beginning of June, right now there's just under a 75% chance we could get that first rate cut. And that's what the market is pricing in here in our country. Not until September where the market is starting to price in a second rate cut, again, about a 73% chance. And the third rate cut that the market is anticipating, they're anticipating, or the markets are anticipating, this won't happen until December, the December Bank of Canada meeting, whereby almost 90% the market is saying that a 1/4 point cut will happen. So to me, it is something that the market has been anticipating. Once upon a time, it was anticipating more rate cuts. We seem to be getting the idea that perhaps central banks will cut rates less and less as the economic data remains strong, as inflation remains stubbornly high in and around that 3% rate. As we know, Bank of Canada, Federal Reserve wants to see a 2% rate. So as inflation stays high, as the data stays strong, tough to cut rates in that type of environment. We have another chart here, inflation and the Fed funds rate. This is core CPI, and you can see how the core CPI has come down, that the Fed funds rate is well above core CPI on the far right-hand side. And lastly here, our last chart of this idea of one rate cut or two is the Treasury yield and federal funds rate. And I think the most important thing to take away from this, as the Fed's funds rate, as the central bank rate started to rise or continue to rise significantly and very sharply, so did Treasury rates. The 2-year in the US now probably about 470 today. When we took this chart, it was just under 460. The 10-year closer to 440 now versus 4.2%. So rates going higher, not a good thing for the market. Something to watch for, to listen for when you hear these Federal Reserve governors speak. Are they talking 3 rate cuts, 2, 1, or maybe none? The last point I wanted to discuss, the third point, with regards to what individual investors should be focusing on and have before you make your investment decisions, as you can see here, is patience. When the market is trading at all-time highs, which we just came off of, a strong first quarter, you need to have patience. You can't just go out and chase individual investment ideas because they've been working. You need to evaluate them. You need to do your research. Perhaps there's another idea in the same sector that is better for you today. And maybe you should hold off buying something. Now, as you all know, I never say to market time, never time markets. If you want to buy something, if you have the money to buy, go out and make that purchase and invest. But there's a difference between buying something that is overvalued and buying something that is have good value or right value on an investment idea. I have a few examples of some charts on some stocks that have done really well, but perhaps you could take a look at some other ideas. And the first one is Eli Lilly. Some of you may know Eli Lilly, big pharma company in the US, diabetes drugs, weight loss drugs, Alzheimer's. They're doing it all right now. The stock has been tremendous, one of the 10 largest companies in the world today. But Eli Lilly, as I look to my notes, Eli Lilly trades at 62 times forward earnings. Pharmaceutical company, does it deserve to have that kind of premium? Perhaps, but maybe you look elsewhere. Maybe you look at a name like Pfizer. Pfizer is a name we all know, COVID vaccines, etc., Viagra, all the different drugs that Pfizer has offered over the years. Well, Pfizer, they trade at 12 times forward earnings, much cheaper. Obviously not doing as well as an Eli Lilly right now, so cheaper for a reason perhaps, but they just made an acquisition. They're moving into the oncology cancer research area. Pfizer also, as I said, trades only 12 times earnings and pays over a 6% dividend today, which I think for now is secure. So you could earn 6% on a very large pharmaceutical company. So another idea, do you chase Eli Lilly or do you buy something a little cheaper with a good dividend? Another example of a stock would be Micron. I thought I'd bring to you something in the chip space. Micron produces chips for memory, and Micron's had a fantastic run, trading at all-time new highs. But as my notes tell me here, Micron is trading at 154 times forward earnings, well over 100 times earnings for Micron. Now, I don't know about you, but that's not a name that I necessarily want to chase. I think if you own it, perhaps you continue to hold it, maybe you trim some profits, which I've done for some clients. But instead of owning Micron and a name that has done extremely well, why not own NVIDIA? We've talked about this name many, many times. We have a chart on NVIDIA. NVIDIA has gone up more than Micron has. And NVIDIA trades 35 times earnings. Still a little expensive, but for a company that's growing as quickly as it is, I don't think it's as expensive as anywhere near a name like Micron or a name like AMD, some of the other chip makers in the space. NVIDIA actually cheaper today, as I've said, than it was a year ago. So again, have some patience. Don't chase some of these high flyers. Buy something that's good quality and a little bit cheaper. Another name, Apple. We have a chart of Apple. I've talked about Apple. Apple trades somewhere around let's call it 26 times earnings today, down from about 30 times earnings. And Apple's a name that is growing high single digits only, paying 26 times for a company that's only growing earnings, 6 to 10%. Instead of Apple, have some patience, don't chase it. Maybe you buy a name like Alphabet or Google. Google trades at just over 20 times earnings, a little bit cheaper. A stock that hasn't, in my opinion, reached anywhere near its potential with respect to its artificial intelligence. There's rumors that Apple's going to be using Google's or Alphabet's artificial intelligence for their products. So rumors that these two companies will team up in the not so distant future. So again, having some patience, looking at buying some names that are maybe in the same sector, but are a little bit cheaper. And lastly, I have a chart here on Invesco QQQ. This is the chart that basically follows the tech space, and you can see how well tech has done. And the reason why I put this up is not because I want you to time the market at all in any way whatsoever, but you can see how well a number of the investments have done. A lot of these are tech names, obviously. And if you have some patience, if you look for some of those diamonds in the rough, you can gain exposure to the space and still do quite well, even after a lot of these names have gone up, and even after a lot of these indices have gone significantly higher.